Imagine if XRP's low price isn't a mistake at all, but a controlled pressure valve in a much larger system. Imagine if every dip, every stall under $3, every strange sideways movement wasn't market weakness, but the quiet sound of a hidden plan unfolding behind the curtain. Because what if I told you some insiders believe that XRP's price suppression isn't chaos, it's coordination? Now, if you love content like this, make sure you hit that like button and please do subscribe so that you don't miss the next video, because what I'm about to lay out will change how you see the entire XRP market. A few days ago, I stumbled on an interview with Dr. Jim Willie, a statistician, analyst, and someone who has spent decades studying capital flows the public never gets to see. And the claim he made me stop cold. According to Willie, some of the biggest banks on earth, including Bank of America and BNY Mellon, have been intentionally keeping XRP under $3, not randomly, not accidentally, but deliberately, quietly, strategically. And the reason? Simple. They want to load up on XRP at bargain basement prices before the world realizes what XRP is really meant for. Now, at first, even I thought that sounded like one of those wild crypto conspiracy theories that crop up every cycle until he started dropping details that were way too specific to ignore. And if you're serious about being ready for the biggest shifts coming to crypto, this is exactly why I built the XRP Millionaire Blueprint. Because the people who win aren't the lucky ones. They're the ones who know exactly how to think, position, and execute when it matters most. Inside, you'll get the wealth building psychology, the precision decision frameworks, and the step-by-step positioning strategies the top 1% use to turn asymmetric setups into real life-changing outcomes. And if you want the maximum edge, you can upgrade to Blueprint Pro, where you unlock every premium resource, including the complete XRP Millionaire Blueprint, the 100x stock formula, and my weekly XRP insider alerts, giving you a private advantage for spotting major moves before they hit the headlines. You can find it in the video description. Now, back to the story Willie told and why it matters. Willie suggested that these banks may actually be coordinating with Ripple itself. Yes, the company behind XRP, the company building the infrastructure layer banks will eventually use to help keep the price contained while institutions accumulate. According to him, the conversation would sound something like, keep XRP under $3 for now. We're not buying it at $7 or $8, where it should already be trading. Just pause for a second and let that sink in. The very banks that once mocked crypto are allegedly asking a crypto company to keep the price low so they can quietly fill their bags. It sounds like a financial thriller, except the puzzle. Pieces start fitting a little too cleanly, because here's where it gets interesting. Exchange wallets holding XRP haven't just been decreasing, they've been collapsing. Coinbase reportedly had nearly 1 billion XRP on the exchange. By September, barely 32 million. That is not a typo. Almost a billion tokens gone from the public market. XRP didn't evaporate, it wasn't burned. It didn't disappear into thin air. It moved quietly into private custody, over-the-counter deals, institutional vaults, places the public can't track. Willie believes NDAs are involved, the kind that legally silence parties from talking about what's really going on. And honestly, that would explain why nobody's saying a word. No leaks, no warnings, no public hints, just silent surgical accumulation. And then there's the Larry Fink moment, CEO of BlackRock, the king of institutional money. Someone asked him about the possibility of a BlackRock CKXRP ETF. Guess what he said? Not we. Have no plans. That's not happening. He said, I cannot say. For Larry Fink, that is odd. If BlackRock CK isn't touching something, he says so bluntly, I cannot say is what you say when you're under restriction, when you know something but can't reveal it yet, when the machinery is already turning, and XRP enthusiasts immediately recognize the tone, the corporate version of a wink, connect the dots. Banks allegedly buying in silence, supply vanishing from exchanges, OTC liquidity thinning, and the biggest asset manager in the world giving a cryptic I cannot say about an XRP ETF. You start to see why XRP holders are buzzing, why some feel vindicated, why others feel like they're watching the early frames of a historic shift in global finance. And Willie's analogy drives the point home. He described Bitcoin and Ethereum as wide pipes, huge liquidity pools, where large amounts of capital can flow without causing major shocks. XRP, on the other hand, is a much smaller pipe, so if even a fraction of the capital flowing through BTC or ETH starts diverting into XRP, the pressure skyrockets. Prices don't just rise, they erupt. Now imagine that pressure being multiplied by ETFs, vehicles that pump in institutional money through a fire hose. And imagine that at the same time, OTC supply is drying up. Institutions can't get their usual deep liquidity. So what do? They buy on the open market, and suddenly there's not enough cheap XRP to go around. That's how you get true price squeezes, the kind that create violent vertical moves on charts. Moves that don't look cryptocurrency sized, they look early internet Amazon sized. And this is where Willie makes his boldest prediction. The one that has the XRP community split between chills and disbelief. He laughs at the idea that XRP's market cap has a ceiling. In his mind, XRP is not just a payments token, it is a future global liquidity layer, maybe even a future trade settlement asset. He even brought up Ripple's RLUSD, a USD representing stablecoin that runs natively on the XRPL, and suggested a world where assets like XRP and RLUSD replace certain roles currently held by US Treasury instruments. His claim, XRP's total market value could one day hit 100 trillion. Yes, trillion, as in larger than the GDP of most of Earth. To be clear, that's not a prediction I'm personally making, but the framework he's describing is interesting. XRP as the neutral bridge asset for international settlement, XRP as the lubricant of global liquidity, XRP as the pipe through which trillions in daily flows eventually move. And when you think about it, if that world ever came true, triple-digit XRP wouldn't be impossible. It would be math. Because on one hand, everything Willie laid out sounds almost too coordinated, too cinematic, too perfectly aligned with what die-hard XRP believers have been saying for years. But on the other hand, there are patterns here that even skeptics have trouble explaining. And that's where things get interesting, because whether you buy into Willie's theory or not, the data doesn't lie about one thing. Something is happening with XRP behind the scenes. Let's start with the shrinking exchange balances. In every previous cycle, when retail got excited, exchange balances ballooned. People kept their tokens on the platforms where they were trading. But right now, the chart is inverted. Instead of supply flooding exchanges, it's disappearing from them. That's the exact opposite of what you expect in a bull market. You'd think people would be depositing more XRP to trade, but instead it's flowing out quietly, consistently, and not in tiny amounts, in massive, almost industrial quantities. When Coinbase drops from nearly 1 billion XRP to just over 30 million, you're not looking at retail investors moving coins into ledger wallets. Retail doesn't move coins by the hundreds of millions. These are block transfers, repeated transfers, systematic accumulation patterns. That is institutional behavior. Institutions accumulate quietly, strategically, without announcing intentions, without triggering price spikes, without alerting retail prematurely. And then there's the OTC question. OTC desks are the bloodstream of institutional crypto trading. When a company or bank wants $50 million worth of an asset, they don't hit the open market. They go OTC to avoid slippage. But multiple reports have said XRP's OTC liquidity has thinned dramatically. That means big players can't get large amounts as easily as they used to. If that's true, institutions only have two options left: wait or start buying directly on the public market. And if even a few of them choose the second option, you get what Willie calls hydraulic pressure, a narrow pipe, massive inflow, explosive upward force. Now let's talk psychology, specifically institutional psychology. If a banker fund believes XRP has a major role to play in cross-border settlement or global liquidity, they will never buy it near fair value. They will accumulate slowly for years if they can. They will suppress excitement. They will dismiss the asset publicly. They will call it risky. They will amplify regulatory fears. They will wait out the retail investors who lose patience, who sell their holdings, who capitulate during long periods of sideways movement. This is not a crypto-only pattern. This happens in commodities. It happens in equities. It happens in currency markets. Smart money accumulates in silence. Dumb money sells from boredom. So if XRP has been stuck under $3 for years, you could argue maybe that's not suppression, maybe that's positioning, maybe that's the long arc of strategic accumulation, maybe that's the prelude. Another interesting angle Willie mentioned, and one that gets glossed over, is the shifting attitude of legacy banks toward Ripple. Years ago, Ripple wasn't taken seriously. Banks either ignored it or saw it as a minor competitor. But fast forward to today, and suddenly major financial institutions are exploring blockchain more aggressively. Some are rumored to be testing Ripple technology quietly, not the public announcements you see on Twitter, the behind closed doors pilot programs, sandbox environments, settlement testing, liquidity modeling. That's how institutional adoption always starts quietly. And this is where the narrative takes a sharp turn. Because if banks are actually testing Ripple systems behind the scenes, then Willie's theory stops being a wild conspiracy and starts being a matter of timing. Banks want the asset they'll depend on, whether for liquidity, settlement, or cross-border rails, to be cheap while they accumulate. No institution wants to deploy billions into something that's already expensive. Cheap accumulation is the name of the game. Even XRP's legal situation fits this timing narrative. The SEC lawsuit dragged on for years, acting as a natural price suppressant. Even if Ripple had nothing to do with any alleged coordination, the timing still conveniently benefited any institution wanting to accumulate XRP without retail interest exploding. Regulatory uncertainty is one of the strongest price dampeners in all of finance. And then the moment the lawsuit finally concludes, the moment clarity returns, what happens? not a sudden moonshot, but slow controlled movement, consolidation, more outflows from exchanges, more silence, no mania yet, almost as if someone is still accumulating. Let's look at market behavior during consolidation phases. XRP has had unusually long accumulation zones, years in some cases, with volatility compressed into narrow ranges, almost as if someone is holding the lid on, not with absolute force, but with consistent counterpressure. Traders often joke that XRP defies normal market logic, but what if it's not illogical? What if it's controlled, even partially? Now let's turn to global liquidity. Ripple has been in talks with central banks about CBDCs. They've been building corridors across Asia, the Middle East, Africa, and Latin America. They've partnered with institutions that handle billions in remittances. They're not building for retail traders. They're building for the financial plumbing of the world. And that plumbing requires a neutral bridge asset. You can't route trillions through slow, clunky rails. You need something instant, something scalable, something with low cost, something with finality and settlement behavior you can trust. XRP fits that description better than any other asset in crypto, specifically for enterprise use. So when people scoff at the idea that XRP could one day play a global settlement role, they're not looking at the engineering, they're looking at the price. And price is often the last thing to reflect an asset's true purpose, especially when accumulation is happening behind the scenes. Willie also pointed out something subtle but important. Institutions tend to deny interest in an asset until the moment they don't. Look at Bitcoin. For years, banks mocked it. They warned people against it. They dismissed it as speculation. And then behind the scenes, they were buying it. By the time institutions publicly embraced Bitcoin, most of the accumulation had already been done. The same pattern played out with gold decades ago, with Tesla stock, with Amazon, with Apple. The public never gets the early invitations. And this brings us to a critical question many XRP holders don't think about enough. What if everything happening right now is simply preparation? Not manipulation, not conspiracy, but preparation for a larger role. Because if a global liquidity asset is going to serve a real purpose, institutions will want it before retail does. They will need enough supply to bootstrap corridors. They will need enough liquidity to settle multi-billion-dollar flows. They will need enough distribution to balance regional needs. And that type of accumulation takes time, often years. And if that's the stage we're in right now, then everything starts to make sense. This is not financial advice. Now, this is where the entire XRP narrative starts to bend in a direction most people are not even remotely prepared for. Because when you zoom out and track the trail of policy signals, liquidity shifts, and cross-border settlement behaviors happening right now, especially in Asia, it becomes painfully obvious that the market is pricing in a future that the mainstream still hasn't caught up to. Japan's yield environment is a perfect example. The BOJ's slow, hesitant normalization is now accelerating because they finally can't ignore global capital flows demanding higher returns. And when yields rise in Japan, it doesn't just affect the Japanese bond market, it sends a shockwave through every FX corridor connected to the yen. That includes the US, Europe, and most importantly, the emerging markets Ripple has been focusing on. So the question becomes, what role does XRP actually play in a world where the yen is no longer the safe, predictable, low-yield anchor it used to be? The answer is buried in settlement efficiency. When FX volatility rises, settlement inefficiency becomes exponentially more expensive. A 2 to 3% spike in a currency during a cross-border transfer window can erase profit margins for remittance providers, institutions, and even central banks. That's why the demand for real-time pre-funding free settlement is not optional anymore. It's becoming mandatory. And this is exactly where Ripple has positioned XRP as the liquidity layer that closes the volatility gap. Think about this. For years, critics argued that volatility made XRP impractical. Today, volatility is precisely the reason XRP becomes necessary. If the yen whips while a bank is waiting 2 days for settlement confirmation through SWIFT, that bank can face massive losses. But if they can settle instantly using XRP as a bridge, the volatility window collapses from days to seconds. This is the part the general public doesn't grasp. Settlement speed isn't about convenience. It's about protecting institutions from billions in unnecessary FX exposure. Now, let's go deeper because there's something else happening underneath the surface that few people have connected. Japan's tightening is not happening in isolation. Korea, Singapore, and portions of the Middle East are quietly mirroring the same trajectory. Rising yields equal rising demand for capital-efficient liquidity pathways, and that means every corridor that used to rely on pre-funded Nostro accounts will eventually need a digital alternative. XRP is literally engineered for this use case. Not theoretically, not conceptually, mechanically. Banks don't want their capital locked in dormant accounts anymore. Not when yields are climbing worldwide. If they can replace pre-funding with on-demand liquidity using a neutral real-time asset, they free up capital, reduce exposure, and execute at lower cost. This shift isn't ideological. It's economic survival. And now looking at Ripple's ongoing expansion in Japan, the Philippines, Singapore, and Australia, a pattern emerges. Ripple isn't chasing integration with US megabanks. They're positioning themselves inside the markets where yield shifts and liquidity inefficiencies are hitting the hardest. It's the same reason we're seeing early hints, quiet regulatory green shoots in the UK, Switzerland, and Dubai. Combined with the BOJ dynamic, these regions create a perfect storm for XRP demand scaling at precisely the moment global liquidity is undergoing its biggest restructuring in decades. But here's the most important part. XRP's price today still reflects a world that no longer exists. The market is pricing based on 2019 assumptions, while the actual infrastructure, political appetite, and monetary pressures have evolved dramatically. And when that disconnect resolves, and it always does, it resolves violently. That's why watching ETF flow data is more important than watching the XRP chart. The ETFs are showing something the price hasn't reflected yet. Conviction from large entities who understand structural liquidity shifts before retail does. They're not trading the news. They're positioning ahead of the policy wave. Japan's yield reversal is only the tip of the iceberg. The real story is the global repricing of settlement infrastructure, and XRP is one of the only assets on Earth with a real, functioning system already built around it. Not a promise, not a white paper, an actual enterprise-level settlement network. Investors underestimate how rare that is. And here's what nobody talks about. Liquidity corridors don't scale linearly. They scale exponentially. One corridor stabilizing its volume through XRP doesn't just benefit that corridor. It lowers slippage and improves execution for all other corridors using the same asset. Liquidity begets liquidity. That's how assets go from niche to systemic. And that's why the BOJ shift combined with Ripple's Asia strategy matters more than anything happening in US headlines right now. Because global macro variables, not retail sentiment, are what drive long-term value into a settlement asset. If you understand that, all the noise suddenly disappears. XRP isn't reacting to the market. The market is reacting to the forces that XRP was built to solve. And as the world re-enters a yield-driven cycle, settlement efficiency stops being a luxury and becomes the battlefield where trillions will move. This is the phase of the cycle where the people who understand the macro picture position early and everyone else wakes up too late. And if you're someone who wants to go way deeper into the real frameworks, strategies, and insider-level signals that actually help you navigate this XRP cycle like a pro, not guessing, not hoping, but operating with clarity, then you need to look at the XRP Millionaire Blueprint Paro. Paro is the complete premium system that unlocks every exclusive resource. I have the full XRP Millionaire Blueprint, the full 100 times stock formula, and weekly XRP insider alerts that keep you ahead of the market before the crowd even knows what's happening. If you want the highest level playbook, the real macro strategies, and the advantage that only top 1% investors use, Pro is where you get it. It's all in the pinned comment below.